Now let's bring in our market panel, Meghan Shue of Wilmington Trust, Paul Hickey of Bespoke Investment Group. Paul, we seem to be bumping our heads on 4,600 here on the S&P 500. Do you think that's close to a ceiling for the near term? And tech and communication services seem to have the hardest time today.
Yeah, so I mean, those are some of the groups that have run up in this rally, John. And so I think it's perfectly normal to see, I mean, this is only one day so far, a little bit of a, digestion period. December historically is a strong month, but all of the gains in December have historically come in the back half of the month. So some sideways trading in the first few days of the month wouldn't be a surprise. And surprisingly enough, this year has followed, the pattern of the market this year has followed the historical pattern so closely. It's amazing when you look at it. There was only a brief period where things got a little bit out of whack in October during when the war broke out in the Middle East. But other than that, it's been following that track, which would suggest, maybe, a little bit more upside ahead. The S&P on a total return basis is only 1% from an all-time high right now.
Yeah, and Meghan, we last had you on, I think, on Halloween, and it was a scarier time in the market. You were right about everything but being underweight equities because the S&P is up about 9% since then. What's your read on the market here and what's happened in the last month plus?
Yeah, well, we were and we have been underweight equities overall, but we've actually been holding a full allocation to U.S. large cap, which has been the part of the market where you want to be for sure. Our underweights have actually been in international developed equities and U.S. small cap, parts of the market that have certainly done very well in November, despite probably some continued headwinds in Europe, as well as maybe a more muted growth outlook in small cap. I think you're going to get some of that catch-up trade, especially because of very stretched valuations in the favorable direction for U.S. small cap. But I would say to get much more enthusiastic than a neutral weight to small cap would take economic conditions that we just don't see panning out in 2024. We have a pretty muted growth outlook, about 1 to 1.5% GDP growth. So soft landing is part of our base case. But for small cap to work, I think you need lower rates and more aggressive growth than that.
I'm going to stay with the small caps here, Paul, for a minute, because you did see selling in bonds. You did see yields move higher. The dollar strengthened today, and yet the Russell 2000 finished the day up 0.9% here, and it's been outperforming the larger averages in recent weeks. Does it continue?
Yeah, Morgan, I think so. So what you look back at is in early November, what we saw is the Russell 2000 end a streak of 34 straight days of trading at oversold levels. That was the longest streak in about 20 years. And what does it take to get 34 straight days of oversold levels? That's indiscriminate selling. People just selling because they don't want to be part of that sector anymore. And that's also the way bottoms get made in various asset classes. So going forward, when you look at those other periods when you've seen that much oversold readings in a row in the Russell 2000, it was higher every time a year later, and there were 12 prior occurrences. Or 10 times it happened. 8 out of 10 times it outperformed the S&P 500 over the following year. When you look at small caps relative to large caps on a valuation basis, they've never been this cheap relative to large caps. And you'd compare the NASDAQ to the Russell 2000, the ratio in those two index prices, it's only been higher than current levels. 60 trading days throughout the index's history. So I think, I don't know exactly if this is the time, but if you look back a couple of years from now, I think you're going to see small caps have outperformed large caps by a pretty sizable margin.
We've got 3.5 weeks, we'll call it, left of 2023. So Meghan, looking to next year, how do investors position themselves, especially when the market's continuing to grapple with some big macro topics that were the themes this year and look like they're going to carry over into next year as well?
Yeah, well, Morgan, I think we're holding still a little bit of excess cash. So we're looking for the market to come off a little bit and maybe for volatility to pick up to think about deploying that. We still hold an overweight to fixed income, expecting interest rates to fall as we move toward continued disinflation and a more muted growth outlook. And then within factors and sectors, I would say you want to be thinking about almost a barbell type of approach. So retaining that exposure to mega cap tech and those structural growth stories, because I think the AI investment is still very early innings, but also starting to look at some of those more beaten up parts of the market, maybe small cap, maybe banks, and some of the more cyclical parts of value. So we're keeping that exposure pretty balanced, and also just continuing to focus on quality. Rates are not going down to where they were in the post-global financial crisis era. They're going to remain elevated. You're going to have some stress in the system in order to get the 5 rate cuts that the market's pricing right now. So I think that focus on quality is going to be very important.